There's a building in Phoenix, Arizona, a modest three-bedroom home built in 1987. Nothing special, beige stucco, a small backyard, the kind of place where a middle-class family used to raise their kids and build a life. And in 2012, that home sold at foreclosure auction for $62,000, purchased not by a young couple ready to start their American dream, but by an algorithm, a piece of software connected to a $16 billion fund that bought 40,000 homes that year alone. And today that same house rents for $2,100 per month while being valued at over $400,000. And the family living inside will never own it, their children will never own it, and their grandchildren, statistically speaking, will never own it either. Because something fundamental shifted in America over the past 15 years, something that most people felt but couldn't name, and the brutal truth that nobody in mainstream financial media wants to say out loud is this: you are not competing against other families when you try to buy a home. You are competing against the most sophisticated capital allocation machines ever constructed in human history, entities that can borrow money at rates you will never access, that receive tax advantages designed by lobbyists you will never meet, and that have transformed the very concept of shelter from a human right into a yield-generating asset class. And unless you understand exactly how this happened and what it means for your financial future, you will spend your entire working life enriching the balance sheets of corporations while believing that somehow, someday, if you just work a little harder and save a little more, you'll finally get your piece of the dream. My name is Godwin. Today I'm pulling back the curtain on what I call the great housing inversion, the systematic transformation of American residential real estate from a pathway to middle-class wealth into a mechanism for extracting that wealth upward to institutional capital. I'm going to walk you through the exact financial mechanics that make it nearly impossible for an individual earning a median income to compete against REITs and private equity. I'll explain why the relationship between cap rates and mortgage rates has created an asymmetric playing field that tilts more each year. And I'll show you what strategic options actually remain for those who understand the game. If you value high-level financial clarity over surface-level noise, if you want to see the machinery behind the curtain rather than just the shadows on the wall, you may want to join this network by subscribing. Let's begin. To understand why you'll never own a home in America under the current system, you first need to understand a single moment in time, the autumn of 2008 and the spring of 2009, because this is when the architecture of modern housing extraction was designed, not in some smoke-filled room, but in broad daylight, packaged as economic rescue. When the subprime mortgage crisis detonated and took down Lehman Brothers, when AIG required a $180 billion bailout, when the entire American financial system stood at the edge of complete collapse, the Federal Reserve and the Treasury Department faced a choice. They could have allowed foreclosed homes to filter back into the market slowly, purchased by individual buyers at reduced prices, a painful but organic correction that would have reset housing to affordable levels, or they could engineer a rescue that preserved asset prices and accelerated the transfer of single-family homes from distressed individual owners to institutional buyers with access to cheap capital. And they chose the second path, not because anyone sat down and decided to steal housing from the middle class, but because that was a path that stabilized the banking system fastest. And in the crisis logic of 2009, nothing else mattered. The mechanism was elegant in its brutality. The Federal Reserve began purchasing mortgage-backed securities, eventually accumulating over $2.5 trillion worth, which suppressed mortgage rates and propped up home prices. Simultaneously, new regulations made it harder for individuals with damaged credit to obtain mortgages. And here's the critical asymmetry. While the average American family that had just experienced job loss or foreclosure saw their credit score destroyed, making them ineligible for mortgages for years, institutional capital faced no such restrictions. BlackRock, through its subsidiary Invitation Homes, Blackstone through its various real estate vehicles, American Homes for Rent, and dozens of smaller but still massive funds, could borrow at rates approaching zero and deploy that capital at scale into markets flooded with distressed inventory. By 2012, Wall Street was buying more than 30% of all foreclosed homes in some metropolitan areas. By 2013, Invitation Homes alone owned over 40,000 single-family residences. These weren't apartment buildings or commercial properties. These were the same suburban houses where American families had traditionally built generational wealth. Now let's talk about the financial mechanics, because this is where most analysis fails. The average person thinks about housing in terms of monthly payments. They calculate whether they can afford a mortgage. They compare it to rent. They don't understand that they are playing a completely different game than institutional capital. When BlackRock or Vanguard or any major REIT evaluates a residential property, they use a metric called cap rate, which stands for capitalization rate. Cap rate is calculated by dividing the net operating income of a property by its purchase price. If a home generates $24,000 per year in rent after expenses and was purchased for $400,000, that's a 6% cap rate. Simple enough. But here's where the asymmetry becomes devastating. An institutional buyer with access to capital at 4% can purchase a property with a 6% cap rate and immediately capture a 200 basis point spread. They're earning 6% on an asset financed at 4%. That spread is pure profit, and it can be leveraged and scaled across thousands of properties. Now consider your position as an individual buyer. In early 2024, the average 30-year fixed mortgage rate exceeded 7%. You're trying to buy the same property that the institution bought with 4% money, but you're financing it at 7%. The institution sees the profitable spread. You see a monthly payment that consumes 45% of your household income. The institution can afford to bid higher because their cost of capital is lower. You either lose the bidding war or stretch yourself into a financially precarious position that one job loss or one medical emergency will shatter. This is not a failure of personal responsibility. This is not because you didn't save enough or didn't work hard enough. This is a structural asymmetry baked into the financial architecture of America, where access to cheap capital is rationed according to scale, and individuals will always be at the back of that line. But wait, you might say, don't institutions have to pay cash or take out commercial loans with their own constraints? And yes, technically that's true, but you're missing how the game actually works. Large REITs and private equity real estate funds access capital through bond markets, through securitization vehicles, through credit facilities extended by the same banks that will charge you 7% on your mortgage. When Invitation Homes issues corporate bonds, they're paying rates far below what you'll ever see at your local credit union. When Blackstone Real Estate Income Trust raises capital from pension funds and sovereign wealth funds, they're promising those investors stable returns backed by the rent checks of American families who couldn't afford to buy the homes they're living in. The entire structure is designed so that your rent payment flows upward through the REIT, to bondholders, to institutional investors, to the wealthy, while you remain on a linear income treadmill, trading hours for dollars, with no equity accumulation, no wealth building, no escape velocity. And here's the question I want you to sit with for a moment, because I think it reveals something deep about the American condition in 2024. If you work a standard 9-to-5 corporate job, if you earn the median household income of roughly $75,000, if you've been responsible with your credit score, if you maxed out your 401k contributions to get the employer match, if you've been doing everything the system told you to do, why is homeownership further out of reach for you than it was for your parents who did the same things with less education and lower nominal incomes? The answer is not laziness. The answer is not avocado toast. The answer is that the rules change and nobody told you. Let me walk you through the second layer of this architecture, because the transformation from ownership to rental isn't just about institutional buyers. It's about how the entire incentive structure of American housing policy has shifted. Consider the tax treatment of real estate investment trusts. A REIT is essentially a company that owns income-producing real estate and is required to distribute at least 90% of its taxable income to shareholders. In exchange for this distribution requirement, REITs pay no corporate income tax. That's right, no corporate income tax. The IRS treats them as pass-through entities. Now compare this to your situation as an individual trying to buy a home. Yes, you can deduct mortgage interest, assuming you itemize deductions and assuming your mortgage interest exceeds the standard deduction threshold, which for many buyers it no longer does after the 2017 Tax Cuts and Jobs Act raised the standard deduction. Yes, you can exclude up to $250,000 in capital gains when you sell your primary residence, assuming you've lived there for 2 of the past 5 years. These are meaningful benefits, but they pale in comparison to the structural tax advantages enjoyed by institutional capital. A REIT that buys 10,000 homes pays no corporate tax on the rental income from those homes. It can use depreciation to shelter income. It can use 1031 exchanges to defer gains when selling properties. It can structure financing to maximize interest deductions. The entire U.S. tax code, as it applies to real estate, was written by and for sophisticated capital allocators. And you're trying to compete against entities that pay lobbyists more per year than you'll earn in a decade to ensure that the code remains tilted in their favor. This is not conspiracy. This is just how the game works. And pretending otherwise is a luxury you cannot afford. Now, let's talk about what this means for American society, because the implications extend far beyond individual financial struggle. When a family rents rather than owns, they are not building equity. Every dollar they pay in rent is a dollar that does not appreciate, does not compound, does not contribute to intergenerational wealth. Studies consistently show that homeownership is a primary mechanism by which middle-class American families build wealth. The median homeowner has a net worth roughly 40 times greater than the median renter. That's not because homeowners are smarter or more disciplined. It's because ownership converted a mandatory housing expense into forced savings with leveraged appreciation. When you pay down a mortgage on property that appreciates, you're building wealth on both ends, reducing liability while increasing asset value. When you pay rent, you're building someone else's wealth. The shift from ownership to rental is thus a massive transfer of wealth from the middle class to the ownership class, a transfer that compounds over decades and across generations. Your grandparents bought a house in 1970 for $40,000 and sold it in 2005 for $400,000. That appreciation funded their retirement, funded your parents' down payment, created the economic cushion that allowed your family to weather job losses and medical emergencies. Your children will not have this cushion. They will rent from REITs until they are 60, with no equity, no wealth accumulation, no asset to pass down. They will be permanent tenants in a country their great-grandparents built. And here's where I want to address the most dangerous narrative in contemporary financial media, the idea that renting is actually smarter than buying, that the flexibility of renting, the avoidance of maintenance costs, the ability to invest the difference in the stock market, somehow makes renting the superior financial strategy. This argument is not wrong on its face. There are certainly individual circumstances where renting makes sense, but it is propagated most aggressively by interests that benefit from a permanent renter class. When major financial publications run articles about why renting is actually better, ask yourself who advertises in those publications. When social media influencers talk about the freedom of not being tied down by a mortgage, ask yourself who is funding that narrative. The invest the difference argument assumes a level of financial discipline that most humans do not possess. It assumes that you will take the money you save by not buying a home and invest it consistently in index funds for 30 years. In reality, most people will spend that money because it's liquid, because there's no forced savings mechanism, because life is expensive and the hedonic treadmill never stops. A mortgage is forced savings. Yes, you pay interest at the bank, but you also build equity every month whether you feel like it or not. The discipline is structural rather than volitional, and for most people, structural discipline is the only discipline that works. REITs and institutional capital understand this, which is why they are so eager to buy the homes you would have used for forced savings. They want you liquid. They want you renting. They want your cash flow feeding their distributions. So what can you actually do about this? Let me be direct. There is no magic solution. There is no secret hack. There is no YouTube guru who will reveal the one trick that Wall Street doesn't want you to know. The asymmetry is real and it is structural. But understanding the asymmetry is a first step toward navigating it. And there are strategic approaches that can improve your position within an unfavorable system. First, you need to understand that geography is not fixed. The institutional buying pressure is concentrated in specific metropolitan areas, primarily in the Sun Belt, in markets with strong rent growth and landlord-friendly regulations. Phoenix, Atlanta, Dallas, Charlotte, Jacksonville, these are the markets where you're most directly competing against institutional capital. If you are determined to own property, you may need to consider markets where institutional interest is lower, smaller metros, Midwest cities, areas with lower population growth but also lower competition. Yes, appreciation may be lower. Yes, the job market may be less dynamic. But ownership at a lower price point beats perpetual renting at a higher one. And the forced savings mechanism works regardless of whether your property appreciates by 4% or 8%. Second, you need to exploit every tax advantage available to you, even if those advantages are smaller than those available to institutions. Max out your Roth IRA contributions, because Roth IRAs allow first-time homebuyers to withdraw up to $10,000 in earnings penalty-free for a down payment. Understand the first-time homebuyer programs in your state, many of which offer down payment assistance, reduced interest rates, or closing cost coverage. If you work for a company that offers equity compensation, understand how to time your stock sales to maximize down payment capital while minimizing tax liability. These are small edges, but in a game of asymmetry, small edges matter. Third, and this is counterintuitive but important, consider whether buying investment property before buying a primary residence makes strategic sense for your situation. The tax treatment of rental property is more favorable than the tax treatment of primary residences. You can depreciate a rental property. You can deduct operating expenses. You can use the rental income to qualify for additional financing. Some young people have found success buying a small multifamily property, living in one unit while renting the others, using the rental income to cover the mortgage, and effectively house hacking their way into the ownership class. This strategy requires more knowledge, more risk tolerance, and more hands-on involvement, but it is a path that remains open even in an environment of institutional dominance. Fourth, you need to understand the cycle of capital and position yourself on the right side of it. Institutional capital is not infinitely patient. When interest rates rise, when cap rates compress, when the spread between borrowing costs and rental yields narrows, institutions become net sellers rather than net buyers. This creates windows of opportunity. The current high interest rate environment, painful as it is for individual buyers, is actually creating stress in institutional portfolios. Some REITs are selling properties to shore up balance sheets. Some private equity funds are facing redemption requests and being forced to liquidate. If you can build capital during this period, if you can maintain your credit score and your income stability, you may find buying opportunities in 18 to 36 months that don't exist today. The key is patience, strategic accumulation, and readiness to act when the cycle turns. But let me close with the hardest truth of all, because I think you deserve honesty more than you deserve comfort. The system as it currently exists is designed to extract wealth from people who work for wages and transfer to people who own assets. Homeownership was one of the few mechanisms that allowed wage earners to become asset owners, to get on the right side of that transfer, to stop paying and start receiving. That mechanism is being systematically dismantled, not through any grand conspiracy, but through the relentless logic of capital seeking yield. Every barrier to institutional ownership that is lowered, every tax advantage that is extended to REITs, every regulatory framework that favors landlords over tenants, every Federal Reserve policy that suppresses the cost of capital for large borrowers while keeping it elevated for individuals, every one of these decisions pushes more Americans from the ownership side of the ledger to the renting side. The question you need to ask yourself is not whether this is fair, because it isn't, and fairness is not a force that moves markets. The question is what you're going to do about it. Are you going to accept permanent tenancy? Keep paying your rent to Invitation Homes or American Homes for Rent? Keep watching your housing expense flow upward through the REIT structure to institutional investors? Or are you going to understand the game clearly enough to find the remaining pathways into ownership, even if those pathways are narrower and more difficult than they were for previous generations? The American dream was never a guarantee. It was a possibility, a door that was open to those who understood how to walk through it. That door is closing, and pretending otherwise is a luxury that only the already wealthy can afford. But a closing door is not a closed door, not yet, and there is still time for those with clarity, discipline, and strategic patience to get through before it shuts entirely. My name is Godwin. You now understand more about the structural forces shaping American housing than 99% of the people trying to buy homes. The question is what you'll do with that understanding. If this analysis was valuable to you, if you want more high-level financial strategy without the surface-level noise, subscribe to this channel. I'll see you in the next one.